Hi, Bill Bodnar here, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So, big week, right? Tons of risk-filled events, and it finally ended with the jobs report, which came out a short while ago. And the jobs report was amazing. In my opinion, it was a Goldilocks figure for both stocks and bonds. So here are the numbers that we need to be thinking about. Number one, 263,000 jobs created on the headline print. Blowout number. Number two, 16,000 upward revisions from the previous months. 3.2% hourly earnings. That was a little bit of a disappointment. We're going to break that down in a second. And then the unemployment rate fell to 3.6%. That's the lowest in over 50 years. So the headline print at 263 was remarkable. And when we put things in perspective, our economy has shown over 200,000 jobs created per month for the last decade. So this economy is still rolling. In fact, it is, in my opinion, re-accelerating right now. The upward revisions was a good sign. And so normally the bond market would take it on the chin with that headline print, the strong jobs, the low unemployment, another tick down in unemployment. But the number that helped the bond market, which made this a real Goldilocks kind of print, was that hourly earnings. Hourly earnings, it was expected to come in at 3.3%, and there was fear that it might even come in hotter. It came in lower, came in 3.2%, which is still great, but not enough to get the bond market to be worried about inflation, right? And that was the piece that I think the bond market kind of rallied. And why was the bond market scared about that inflationary component? And why is it rallying a little bit after a strong jobs report? Well, earlier this week, the Fed came out and did their thing, right? Of course, they didn't raise rates, wasn't expected. But they used the T word, right? Once again, to describe low inflation. T word being transitory. And transitory is something that means temporary, short-lived. And if you've been watching us and reading Mortgage Market Guide, we have poked fun at that for quite some time. Inflation, if it's low for a decade like it has been, it's not transitory or temporary. It's like fixed there. And so this number kind of gives us an idea, this hourly earnings, that maybe this inflation is going to remain this way. And listen, the Fed can't raise rates as it relates to mortgages. They can't touch long-term rates. They can kind of jawbone, they can try to talk them up, but they can't actually, there's no monetary policy that they can do something to kind of knock them higher. Inflation is the key to higher rates. And right now we're not seeing it. So this was an incredible week for the bond market to get through, right? A lot of risk events. And from a technical basis, you can see here on the chart, we're bouncing off the 50-day moving average. And when this is a really nice sign. I love the way this chart looks. We did not give up this 50-day moving average for 2 days in a row. And it looks like, heading into the weekend, hopefully we stay where we are and we bounce off this 50-day moving average still heading into the weekend. The 10-year note remains beneath 260, which is also a very positive sign. So, when you put this all together, it's an amazing Goldilocks situation. If you're going out to partners, you're going out to clients. I mean, you have a tight labor market, low inflation, wages growing, but not too hot to stoke inflation. The Fed has already said they're going to remain patient this week. So, goodness, I mean, this is going to be a tailwind for the housing market for the foreseeable future. Now, looking into next week, the good news is a lot of the headline risk events are away. So when we talk about steady as she goes, you can see that nice sideways band in pricing. I'd like to think that's going to continue for the foreseeable future. We like to call it here at Mortgage Market Guide lower for longer. I think next week's another week where no big news items. We do have CPI Monday, but again, it would be a shock to see this thing blow out of the water based on some of the underlying components with wages and stuff like that. So, heading into the weekend, boy, I tell you, I like the idea of course, as you get close to closing within that 30 days, still lock what's here because we're at, 13, 12 months lows in rates. But at the same time, if you have longer term locks, I would certainly look to float until we break beneath that 50-day moving average. If we break beneath the 50-day moving average, you could see the 200-day moving average is nearly 90 basis points beneath current levels. Pricing would get away from us, but I don't see where the impetus is to push prices below it, at least for right now. So we're going to be watching it closely for you, of course, and then we'll alert you. But for now, have yourself a great weekend. Enjoy this, wonderful environment we're in, and have a great one. Talk to you soon. Bye for now.